Jonathan Pingle joins us now. I think the bigger question, Jonathan, is when you think the first cut will come and how many there will be. What do you think?
Yeah, thanks, Sarah. So we think the first cut comes at the March meeting, and that's really just a story about inflation. Inflation's falling faster than the FOMC participants have been projecting. We think that's going to continue to be true for the next few months. And, in our forecast, inflation is going to be, below 3%. Core PCE inflation on the 12-month basis is what I mean. As they walk into the March meeting, and at that point sort of begs the question why they need the funds rate, the target range up at 5.25% to 5.5%. So we think they are going to try to make some adjustments to nominal rates in the first half of the year, basically to prevent, the funds rate from getting increasingly restrictive or unnecessarily restrictive in real terms.
And then then how many after that?
Yeah, no, we've got this in sort of two phases, and I'm sorry to overcomplicate this, but we do have the first cut in March, 25 basis points, 25 basis points in May, and 25 basis points in June, just to address inflation. But we see the economy slowing, and then the Fed picking up the pace in the second half of the year, taking rates below 3% at the December meeting.
Oh, wow. So you're well below consensus there on where you expect rates to go.
Yeah, I mean, we see inflation falling, really pretty rapidly. And in our forecast, that continues to be the case through the first half of the year. And what that does is it gives the Fed, a lot of room to address any slowdown in growth. And since, we think there are still reasons to be concerned about the economic outlook in 2024, we have a slowdown in the middle of the year. And we think with inflation getting so close to 2% that the Fed's going to have the ability to try to lower rates more rapidly and prevent worst-case economic scenarios from unfolding.
Jonathan, Bob Pisani here. Happy New Year. So the market's position right now for 6 rate cuts, no recession, and 10, 11, 12% increase in earnings. So it's sort of perfectly positioned. I guess what could go wrong with this scenario? You mentioned the slowdown in the economy. What does that mean? Is there recession, no recession? Game this out for us.
Yeah, thanks, Bob, and Happy New Year to you both, too. We have a mild recession in our baseline economic forecast and broadly see slowing, largely as a result of really consumer spending finally, sort of running out of steam. The last year or so, the consumers held up well, but a lot of the gains we think have been due to, wealth effects, spending down savings, with the ability of households to, re-leverage and really deploy their strong balance sheets. And we think the fiscal thrust has been, quite supportive for growth. And we expect those positive forces to weigh as we roll through, or at least wane and provide less support as we roll through 2024. And if consumer spending slows, less fiscal support, when we look at, say, the industrial side of the economy, it doesn't look strong enough to really drive a lot of growth without that help from consumer spending. So, we think we're going to end up with a relatively soggy 2024 when we look back at the end of next year.